Hello, I'm going to be briefly talking about adjusting journal entries. Adjusting journal entries are made in the general journal to record revenues that have been earned but not recorded, or expenses that have been incurred but not recorded, and vice versa. Adjusting entries arise because the exchange of cash does not always coincide with the earning of a revenue or incurred expense. For example, a business may receive cash before a revenue is earned, while at other times cash is received after a revenue is earned. Likewise, a business may pay cash before an expense is incurred or after. Scenarios: if cash is received before revenue, the entry would be deferred revenue, which simply means that the service has not yet been carried out but has been paid for. Once the service has been carried out, the business will then make the adjusting entry to clarify that the service has been carried out by adding an amount that would cancel out the deferred revenue entry. Second scenario is if cash is received after revenue, the business would record it as accrued revenue. By doing so, the business identifies that the revenue has not yet been billed to the customer. The adjustment is then made later when the bill has been paid by the customer. Third scenario is when cash is paid before an expense, an entry of deferred expense is applied. This means that the company has paid for a service or product but has not yet consumed it. After consuming the purchase, the business would then make an adjusting entry to cancel it out. Fourth scenario: let's say cash is paid after an expense. How a business would keep track of that is through an entry of the account name of accrued expense. This is done to keep track of an expense that the business owes. Upon paying it off, an entry declaring so would then be made. To summarize adjusting entries, the purpose of an adjusting entry is to record revenues that have been earned but not recorded, and expenses that have been incurred but not recorded. Every adjusting journal entry will affect at least one revenue or one expense account. The reason they arise is because of the differing timing of revenue and expense from the exchange of cash. Thank you for listening.
Created using Powtoon.